Hi, I'm Steve. I'm going to share my thoughts on how you can achieve a better financial future. Please remember, I don't know anything about your situation, so think for yourself and use what fits. Welcome back to our conversation on debt investing. From an analytical perspective, it's easy to identify the risk premium associated with each of these three risk factors. U.S. government debt obligations have no credit risk. They have the printing press after all. To separate maturity date risk from interest rate risk, we can compare the rate of short and long maturity government securities. This is called the yield curve. Having quantified these two risks, we can compare the return on corporate bonds from issuers with different credit ratings to understand the credit risk premium. The least risky form of debt is very short-term debt issued by the U.S. government. You'll also get paid little more than inflation for holding this debt, i.e., you'll break even in real terms. A fine idea if you need the money the next year or two, but a poor choice if you're saving for a retirement that's 25 years off. Moving on, let's cover a bit of the terminology unique to debt investing. Rating agencies like S&P and Moody's issue opinions on how creditworthy issuers are. Rating agencies are like referees. They score the game but do not participate directly. These agencies make mistakes, but the market still values their opinions. Duration is a very important term these days, but the definition is a bit confusing. The common meaning of the term duration is well known. In bonds, however, it has an alternate meaning. Here, duration is the amount the value of bond will change if market interest rates change by 1%. For example, a 30-year government bond might lose 15% of its value when interest rates rise by 1%. Therefore, the duration of that bond would be 15. The longer term the security is, the higher the duration will be. With interest rates near record lows, it pays to be very careful with long-term debt. A 30-year government treasury pays about 3% per year. However, if market interest rates rise by 1%, the value of the security will drop by nearly 20%. Seems like a lot of risk for a small guaranteed return. Well, that's it for this session. Thanks for watching, and I'll see you next time.